Hey now, you're an all-star. Get your game on, go play. Hey now, you're a rock star. Get the show on.
All right, we're back. Big Money, Big Daddy. This is Mark Conley, and we are talking about the three types of money, being the accumulated money that you're investing and that you're saving, being your lifestyle money to make sure you're actually saving enough money so you get to enjoy life now and in retirement, not just one or the other, and transferred wealth. Have you set your plan up so that you've got the least amount of wealth being transferred from you to other people or institutions as prudently is possible? We talked about the areas people are losing tons of money in the insurance category. Doesn't mean, and believe me, we are big believers in the appropriate protection for your family. That's the right thing to do, and you better do it, but you better do it the right way, in our opinion. And then there is the expenses, and we're kind of going through those. We were talking about interest. I mean, the world works with borrowed money. I get it. You know, you borrow money to go to school because it gives you the education to go make the money that you want to. You borrow money instead of coming up with all the cash for a car because it's a depreciating asset anyways. You borrow money so you can live in a home and not have to pay rent. Totally get it. But how are you structuring this debt to be the smartest way possible for you? Are you doing it the right way? And, you know, that's what we looked at. We looked at with the mortgage. A lot of times people try to pay off they make extra payments, or they do a 15-year instead of 30, and they don't realize they're getting rid of a serious tax deduction that's there. I mean, when I look at tax deductions, really the only way to get deductions nowadays are either give it away to charity, which is good, but you are actually giving the money away, so it's not like it's a tax benefit, or you have a mortgage on your home. The problem is that mortgage interest costs a lot of money over time. I mean, if you bought a $350,000 home and you got a 4% mortgage interest rate, you now control this $350,000 asset, but the reality is over 30 years, you're going to pay $251,000 of interest. So, I mean, that's a lot of interest. And the reality is it's even worse than that, because had you not paid that interest to the bank, you could have had that money, you could have saved it, you could have invested it, and you could have had that money when you got to retirement. Well, the interest of $250,000 at just a 4% rate of return, and I know some of you are doing better than that, should be, is $1.1 million that you don't have in your retirement plan. So when I tell people that, they're like, wow. I mean, getting a mortgage sounds like a terrible thing. It cost me $1.1 million. Well, not necessarily, because there's another side of the story. What if you didn't get the mortgage? What if you had a rich uncle that gave you the $350,000 to buy the house day one? Well, that's kind of cool, right? Well, if you paid cash for the home, then what's the cost? Here's the answer. It's the opportunity cost, because if you paid cash for the home, you could not do what with the $350,000? Couldn't invest it. Now, does a home appreciate? Sure, but it appreciates whether you paid 100% cash or you did 100% financing, so that's not relevant to the equation. You lose the opportunity to invest it. Well, interestingly enough, if you invested $350,000, you got a 4% rate of return over 30 years, it'd be about $1.1 million. It's the same thing either way. Whether you get the mortgage or not, it's the same thing either way. Unless I factor in the tax deductions, so those do matter, and if I factor in what's called the spread, the difference between what the mortgage costs me and what I can get in my investment account. And really, I'd like to add one thing to that. I will here in a second. But so, in other words, if you've got a 4% mortgage and after the tax deduction, let's just say based on your circumstances, it was really only costing you 3%. Well, if you felt like with your risk profile, it was reasonable to expect, which it's never guaranteed, but a rate of return of, say, 7%, in effect, when you make extra payments on the mortgage or you get 15 instead of 30 a year, you're giving up 4% return on your money. So you're actually worse off paying off the home. That's the math, okay? I don't want to hear people yelling at me, I pay off my home. Fine, I'm not telling you not to pay off your home. I'm just telling you there's math that goes behind it. Now, I also know there's a lot of people who hear that and go, oh, that math sounds great. So cool, let's get the 30-year mortgage, and now I get to buy the BMW I've been wanting. Well, that defeats the whole purpose. You actually really have to save the money or the math doesn't matter. And most people, many people, I should say, probably won't save the money. So there's going to be some of you listening that you should do the mortgage and you do have the discipline and you will save the money. Well, you know what? That's going to be awesome for you because you are going to end up in a far superior position in the long run. But some of you, just be honest with yourself. I ain't going to do it. I spend my money, or I'll start the investment account, and 3 years down the road, I'm going to go, hey, look, we've got $20,000 in this account, and I've been wanting to go on the Disney cruise and, well, whatever it is, right? So those are the things. So you start to see how a financial plan is more than just the math. I like to give you the math. I like you to understand the math. But the reality is it's also about behavior and coming up with a personalized plan that works for you. Student loans, same principles. The differences are most people that make a higher income, the interest is not deductible, and normally the interest being charged on those is a lot more, and it normally makes sense to try to pay it off as quickly as possible. Now, there's different programs out there. So like some of our doctor clients, they have debt forgiveness programs that we review and look at if that is applicable or makes sense. There's all different kinds of things that come into play there. But again, if you don't know, you need to call us, 713-826-0426. Just set up a time to talk, 713-826-0426, or email us at bmbd@wealthdesigngroup.net. Now, one of the first things we do when it comes to these expenses that we help people is we make sure that they've got an appropriate debt strategy plan. So if you got a lot of debt, we're going to show you exactly how to get out of it in the fastest way possible. And no, it's not just pay the highest interest off first. So way more to it when you look at the cash flows. We have complex formulas that will show you how to do it the fastest. Now, some of you that we sit down with, debt's not your problem. In fact, you've got wealth as your problem, and you've got all kinds of people willing to give you money, and you're trying to figure out how to best utilize it to capitalize on opportunities. Well, we got strategies for that too. We will make sure that we are helping you utilize when it makes sense to finance, when it makes sense to use cash, no matter what those circumstances are. We even have some of our really wealthy clients, they've got a lot of real estate, but they also know that they've got this huge, estate tax problem, and they want to pass most of their wealth on for generations to come. And so, but all their money's tied up in these great investments that they do in the real estate world. Well, a lot of times they'll come in and they'll finance their estate plan, and you'll be able to get large quantities of life insurance that's paid for by the bank, and then it's the way that that's paid off is at some point some of the real estate gets sold. But in those instances, we can utilize their wealth to put them in a powerful position to protect them from the legacy planning they're wanting to do. So that's kind of an example on the other extreme. So taxes is a big deal. I talked about taxes. I mean, when I look at the history of taxes, we'll take a little bit of time and we'll go into retirement plans because they're so popular. And number one, I mean, if you've got a company and they're doing a match, that's free money. Of course, you want to do those retirement plans. But a lot of times you're faced with a decision. Let's say that you've got a 401k through work, and they'll say, well, do you want your 401k to be a traditional 401k or do you want it to be a Roth 401k? Well, how does that wealth transfer work? What's the differences between those? Well, first thing that we should do is we should understand what the difference between the two is. So number one, let's say that you make $250,000 a year, and let's say you we'll just say $10,000 into a traditional 401k. That means that you only claim that you made $240,000 in that year to the IRS, all right? So you avoid paying tax on that $10,000 that you saved. But when do you pay the tax? That's right, when you get to retirement, when you go to take the money out. Now, what many people will say is, yeah, but when you're in retirement, you're in a lower tax bracket. I will say that most people are. Probably 95% of the population is in a lower tax bracket than before they retired. That's also because 95% of the population doesn't save any money. So if you actually do save money, that may not be you. Most people listening to a show like this are probably interested in saving money. So the reality is, I don't know. I mean, I don't know what tax rates will be in the future. Congress could raise them. So maybe that's a problem. Maybe not. Well, we could do the Roth 401k. So we're making $250,000. We save 10. We still pay income tax today on $250,000. But now, no matter what that money grows to that we invested, we get it tax-free. Which is better? Depends on your circumstances. And all you're doing, by the way, is you're making an educated guess based on those circumstances, because nobody knows what the laws and the taxes will be next year, much less 20 years from now. But I do think it's interesting to look at the top tax brackets over time. I mean, if I look at the average top tax rate, which right now we're at 39.6%, but the average is actually 58.24%. Now, granted, there's some times in there where it was at 94% during World War II and 91%, which brings up that average. I get that. But, and you had to make a significant amount of money to be in those tax rates. But if I go just to the 70s, okay, the tax rates were 70%. Okay, and these were for what you would consider middle class people. People forget. It's like it never happened so long ago. The 70s was so long ago. I mean, even the 80s, it was 50%. And it's gone down to 28. It's gone to 40, to 35, back to 39.6 that we're at right now. I don't know where it's going. And you don't even know you'll be in the top tax bracket. So it depends on your circumstances. It's just, you got to think through how you're going to do this. And at the end of the day, because nobody does know, I always tell people this. No different than you diversify in the investments that you use, you should diversify in the different tax strategies that you use. And if you're a high income earner, max you could put into a 401k anyways is $18,000, right? So, if you're making $250,000, we know you need to be saving $50,000 a year. So, yeah, you might put $18,000 in the 401k, but you still got to find somewhere else to put money. So you need to find some other strategies. And one of the strategies we talk about on the show that's a terrible idea just from an investment standpoint is actively managed stock picking strategies, because according to Standard & Poor's, and they come out with a report every year, it's only 20 to 30% of active money managers. These are the smartest, the wisest, the brightest in the business, the brilliant minds of the mutual fund industry and money management industry. And they don't even beat their benchmarks. That's pretty much how it goes down. And the ones that do, it's a different group each and every year. So just from an investment standpoint, I don't advocate using that type of strategy. But if it's not in a retirement plan, it gets even worse. Because guess what happens is they buy and they sell. Yep, you got it. 1099s, more taxes to pay. So not only did they underperform in most instances, some outperform, okay? But you got to pay tax on it too. Womp, womp. Not a good way to go. But those are other tax. So again, there's a better way to save where you don't use stock picking, you don't use market timing, you don't use track record investing, and you do use free market portfolio theory that's based upon brilliant minds, PhDs, statisticians that will help. I butchered that word, but that's okay. That will help with math and science, evidence-based investing. That's what we're looking for. Because you know what else? When you do it that way, there's still taxes, but they're way less, way lower. So when you put all that together, you make sure that you put a plan where your circle of wealth, you're looking at all three phases, the accumulation phase, what you're saving in and how you're saving it, but you're also paying attention to lifestyle. You've got an overall plan. You're putting yourself in control of your money. Okay, capital is key. Be in control, and then you're reducing those transfers. That's how you want to do it. That's what puts together a good plan. Factoring in opportunity cost, which is always going to be there, but just you're trying to make sure you've got the least amount. And that's one of the things that we do. So we help with that. And that brings us to the bop bang boom hard truth minute that only a good Big Daddy would tell you. Listen, there's three types of money, baby. Yeah, accumulated and investments that we always talk about. But how much are you losing in taxes and costs? Not to mention, you're probably not even saving enough. Look, if you don't know if you're saving enough, take the time and build a plan. There's three major ways that you're transferring wealth from you to someone else: insurance costs, interest costs, and taxes. Are you 100% positive that you're giving away the least amount possible to still have a very prudent plan? Again, take the time and build a plan. If you want to build a plan that gives you the best strategies, that puts the right chess pieces in play to maximize your cash flow and give you checkmate at some point, you need to talk to one of our advisors at Wealth Design Group. We're just a phone call away. 713-826-0426. You can email us, bmbd@wealthdesignGroup.net. It's Big Money, Big Daddy, bmbd@wealthdesignGroup.net. Again, the number 713-826-0426. And you need to come to our live coaching events. They're awesome. They're fun. It's good food. Perry's Steakhouse, come on. But it's the information. You need to know what these 7 deadly traps are, the mistakes that people are making that's crushing their ability to have the type of retirement lifestyle they want. You want to know about that? Just like our Facebook page for Big Money, Big Daddy, or just text the keyword daddy to 72727. Text daddy to 72727. Big Money, Big Daddy, baby.
I've had enough of scheming and messing around with jerks. My car is parked outside, I'm afraid it doesn't work. I'm looking for a partner, someone who gets things fixed. Ask yourself this question, do you want to be rich? I've got the brains, you've got the looks. Let's make lots of money. You've got the brawn, I've got the brain. Let's make lots of money.
Hypothetical examples discussed are not intended to suggest a course of action or represent the performance of any product or security. All investments contain risk and may lose value. Past performance is not a guarantee of future results. Diversification does not guarantee profit or protect against market loss. Investing in foreign securities may involve heightened risk, including currency fluctuations, less liquid trading markets, greater price volatility, political and economic instability, less publicly available information, and changes in tax or currency laws. Such risk may be enhanced in emerging markets. The S&P 500 index is generally considered representative of the stock market as a whole. It, however, focuses on the large cap segment of the U.S. market. Indexes are unmanaged and you cannot invest directly in an index. Wealth Design Group does not give tax or legal advice. Anything mentioned in the show related to these items is not advice, and you must check with your CPA or attorney prior to taking action. Securities products and advisory services offered through Park Avenue Securities, a member of FINRA SIPC.